Welcome to The Explainer. Today we're digging into AGCO's latest earnings and wow, this was a weird one. It's a classic case of Wall Street loving a stock for about 5 minutes and then completely turning on it. So we're going to break down exactly what caused that whiplash.
Okay, so right out of the gate, here's the central conflict. On one hand, AGCO delivered a solid beat on earnings per share, on profit, and, that's what usually gets investors all fired up. But at the exact same time, they missed on revenue, on sales, and that immediately throws up a huge red flag about what customer demand really looks like.
And you can literally watch this conflict play out in the stock price. The initial reaction to that profit beat, it sent the shares soaring up 4% before the market even opened. But as the analysts and the big money managers actually dug into the details, well, all that optimism just evaporated. The stock ended the day down almost 3%. So what on earth did they find?
To really get what happened, we've got to start with the good stuff. Let's look at the headline figures that drove all of that initial excitement.
Now, see, it wasn't just the earnings beat for the quarter. The real kicker, the thing that really got investors excited, was that management raised their guidance for the entire year, bumping that forecast up to $5 a share. That is a massive signal of confidence. It suggests they have a really good handle on their costs, and that is what sparked that early rally.
But, and this is a huge but, when you dig just one layer deeper, you find a company that's really telling two completely different stories. You had this incredible 20% recovery in Europe, the Middle East, and Africa, which was totally masking a brutal 32% collapse in their most important market, North America. And this split, this divergence, it's the key to everything. All right, so how did management themselves try to spin this? Let's get into their narrative from the earnings call. The main theme from the CEO was all about resilience. The message was basically, look, we know the market is tough right now, but we are laser focused on the things we can actually control. It was about weathering the current storm while aggressively pushing forward on their big long-term plan. And this wasn't just talk. I mean, they laid out 5 very specific, very concrete actions they're taking to completely reshape the company. They're doing everything from selling off assets to fund a huge stock buyback to creating a whole new high-tech precision agriculture business. The end goal here is to build a fundamentally more profitable company no matter what the ag cycle is doing.
So the takeaway from their point of view is this. They think the industry is finally hitting bottom. So they're taking their medicine now, and that includes deliberately cutting production in North America, which hurts, but they're doing it to clean house and get ready for the next recovery with a much stronger financial footing. Okay, so management has this confident, long-term story, but the market sold the stock anyway. So let's peel back those layers of doubt and look at the key concerns that just completely overshadowed that long-term vision. First and foremost, you just can't get past the sheer size of this collapse in North America. A 32% drop in sales, that isn't a dip, that's a cliff. And it signaled a problem much, much deeper than people thought. And this number is the reason why. It turns out their dealers in North America are buried in inventory. They are sitting on 8 months worth of supply. 8 months. And to put that into perspective, their target where they want to be is 6 months. So they are way over. And that signals a really long and painful cleanup process with more production cuts that are going to drag down profits for a while. So when investors put all these pieces together, the short-term picture starts to look pretty grim. You've got the massive inventory problem, you've got them admitting to more discounting, which means pricing power is fading, you've still got tariff risks hanging around, and the outlook for their most profitable, high-horsepower equipment is just plain awful. It's just a whole lot of headwinds that their long-term plan can't fix overnight. So let's put it all together. After all of that, what's the call on AGCO from here? This really brings us to the core debate for the stock right now. Is AGCO just another victim of a really brutal farm cycle, or are the changes they're making under the hood creating a true long-term winner? So you have 2 camps. The bull case, on the left, is all about trusting the process, believing that these big strategic shifts are for real and that they're building a permanently more profitable company. But the bear case, on the right, it's focused on the fire burning right now, saying you just can't ignore the deep, cyclical pain hitting their most important market. Our call here is market perform. Look, the company is doing a lot of the right things for the long haul, and that story is really compelling. But the stock is probably going to be stuck in the mud for a while, trapped between that promising future and a very difficult present. We think it's likely range-bound until there are much clearer signs that the worst is finally over for North American farm demand.
This is not financial advice.